Last week, TSMC, the most important chip maker on the planet, posted the best quarter in its history, $22 billion in profit, beat estimates by nearly $3 billion, and the stock fell. If that confuses you, it's because you're reading earnings reports in the wrong order. Almost everyone is. Retail investors read a report top to bottom, the way it's presented. Headline first, details later. Fund managers read it almost exactly backwards. And that reversed reading order is the entire difference between being blindsided by a reaction like TSMC's and seeing it coming while the report is still loading. So I'm going to give you the exact order, 5 steps, the same sequence I run on every report. And by the end, you'll be able to open any company's earnings and know within minutes what the market is actually going to care about, not what the headline says, what moves the stock. Step 1 is a counterintuitive one. When the report drops, skip the headline numbers, revenue, earnings per share, beat or miss, glance at them, then move on. Here's why. The headline is the past. It describes a quarter that ended weeks ago. And more importantly, it's already priced in. Wall Street analysts spent 3 months estimating those exact numbers, and the stock price today already reflects the consensus expectation. So beat by 3 billion doesn't mean stock goes up. It means the past was slightly better than guessed. The market doesn't pay for the past. This is why companies beat earnings and fall all the time, and why people who trade the headline get whipsawed constantly. The beat is not the story. The beat is the cover of the story. Professionals check it in 10 seconds and go hunting for the thing that actually matters, which is step 2. Step 2 is find the guidance, what management says about next quarter and the full year. This is where fund managers go first, and it's where the stock's reaction actually gets decided. The logic is simple. Once you see it, a stock's price is a bet on the future. So the only genuinely new information in an earnings report is what the company says about what's coming. Next quarter's revenue range, full year outlook, whether they raised or lowered their own forecast. The past quarter is confirmation. The guidance is news. Watch it work on TSMC. The record profit priced in. What moved the stock was in the forward-looking lines. They raised their spending forecast by $10 billion, and this is the part most coverage skipped, warned that their newest technology and overseas factories would compress their profit margins in the coming quarters. Record past, cloudier future. The market traded the future. It always does. Which brings us to step 3, because inside the guidance, there's one number that matters more than the rest. Step 3, margins, specifically gross margin. What percentage of each dollar of sales the company actually keeps as profit before overhead? Here's why professionals fixate on this while retail ignores it. Revenue tells you a company is growing. Margin tells you whether that growth is worth anything. A company can grow revenue 30% while its margin shrinks, which means every new dollar of sales is less profitable than the last one. That's the growth getting more expensive to produce. And it's one of the most reliable early warnings in all of investing, because margin pressure shows up in the report before it shows up in the profit line. The move is simple. Compare this quarter's margin to the same quarter last year. And more important, compare the guided margin to what the company has been delivering. If a company is growing but guiding margins down, you found the tension the market will trade. That's precisely what happened with TSMC. A margin warning of a few percentage points buried in guidance outweighed a record $22 billion profit. Margins are where the truth about a business's health lives. This is the exact reading order I run on reports every season, and I break down live examples in a free weekly note. The link's below if you're interested. 2 steps left, and the last one is where companies accidentally tell you the truth. Step 4, look at how the profit was made, because not all beats are real. Companies report 2 versions of earnings, the official accounting version and the adjusted version, where they exclude things they'd rather you not count. Restructuring costs, one-time charges, stock compensation, things like that. Sometimes those adjustments are legitimate. Sometimes the entire beat only exists in the adjusted number, while the official one missed. The gap is a signal. The other thing to scan for, one-time items. Did profit jump because the business improved, or because they sold a division, got a tax benefit, or booked some gain that will never repeat? A beat built on repeatable business is worth paying for. A beat built on one-time items is a photograph of something that already ended. It takes 90 seconds to check, and it's the difference between a real quarter and an engineered one. Step 5, the professional's favorite, the earnings call. Specifically the Q&A, where analysts ask questions and management answers live, unscripted. The prepared remarks are marketing. The Q&A is where truth leaks. And the highest signal moments are the dodges, when an analyst asks a specific, reasonable question and gets a vague non-answer. On TSMC's call, an analyst asked directly where the extra $10 billion in spending was actually going. The answer was, it depends on the market situation. That's not an answer. And evasion on a direct question about a $10 billion decision tells tells you management either doesn't know or doesn't want to say, both of which are information the press release will never give you. You don't need to listen to the whole call. Transcripts are free online. Skim the Q&A and mark every question that got a soft answer. Those are the exact spots where the next quarter surprise usually come from. Here's the frame that holds all 5 steps together. An earnings report is a document management wrote. It's arranged to lead with what they're proudest of. Your entire job as a reader is to reverse that arrangement. The headline is the past. The guidance is the future. The margins are the quality. The adjustments are the honesty. And the call is what they're afraid of. Read in that order: future, quality, honesty, fear. TSMC falling on record profits wasn't irrational. It was fully legible. 3 lines below the headline to anyone reading in the right order. That's the whole skill. Not more information, the right sequence through information everyone has. If you want this kind of framework applied live every week, real reports, real reads in plain language, the free weekly note is the place to start, linked below. And if you want the full system, how I connect earnings reads into a complete way of analyzing markets, the course goes all the way through it. That's below too. But start with the free note. Send this to someone who saw record profit stock falls last week and thought the market was broken. It wasn't. They were just reading in the wrong order. I'll see you in the next one.